Hi, I'm Steve Rising with the Forex Trading Institute. I want to take a few minutes here to talk a little bit about trend following versus scalping. Let's take a quick history lesson on trading. Trend following has been around for decades. Markets had to be viewed from a much different perspective than we can look at them now. Because of this, there is decades of information about trend following. That is why trend following is so popular. There is a direct relationship to the increase in individuals getting involved in the markets to the increase in the flow of market information to individuals. In other words, as people became more involved in markets, so too did more information flow, and the way we approached and looked at markets, our perspective was constantly shifting. Hence, most individuals that started trading in markets typically were trend followers. Because of this growth in trend following and in trading, trend following became somewhat of a self-fulfilling prophecy. Markets moved much slower because the flow of information was much slower, the directional bias was much more consistent, and so the way we approach markets has dramatically changed here in just the last few years. So Trend Following 101, it was a simple formula. Traders looked at various types of fundamental information. Once again, the flow of information was different. Positive information made price move north over time. Negative information made price move south over time. Now that's an oversimplification, but that's kind of the core of what trend following is based on looking at fundamental information. Now let's fast forward through time. Internet access changes the face of trading. Now online trading begins to emerge. We really only had high-speed internet started to come into its own in just the last 5 to 6 years. So online trading, electronic trading is still very, very new in the scheme of things. Without online access, the only traders that could take advantage of smaller intraday moves in the marketplace were floor traders. Now, with online access, anyone can take advantage of these intraday moves, otherwise known as scalping. Online trading was not very popular until everyone had high-speed internet access. Once again, statistics show that it was just a little over 5 years ago when high-speed internet began to become readily available. Online trading is now the fastest-growing segment of all markets. Because online trading is relatively new, so too is scalp trading, which means there is mountains of information about trend trading compared to the amount of available information about scalping. This also means that old school traders put more stock in trend following techniques than scalping techniques. In other words, they're stuck in the past. One of the key advantages of scalping over trend following is there's less risk because we can trade with very small stops as scalpers. The reality is scalping suits most people over trend following because, once again, scalping has less risk. It requires less amount of money than to trade. We can achieve a profit in a shorter period of time. And most importantly, scalpers sleep better because they're not in a trade overnight. The reality is that because scalping is still relatively new, most individuals attempt to learn to trade a trend-following technique and try to scale it down to a smaller time frame to trade on an intraday basis. That concept does not yield consistent profits over time, but it is the direction most people take because there's more information available on trend following than scalping. A common mistake the self-taught or trial and error trader makes is to commingle this information, strategies, and techniques, ultimately becoming what I have labeled the 50-50 trader. They make money, they give it back, they make money, they give it back. Sometimes things work out, and sometimes things work, and sometimes they do not, which ultimately means trading performance is really based more on luck than skill. As a scalper, we do not use any trend-following techniques, which means you have to be careful what type of information you're viewing. Since 90% of the available information is founded on trend following, once again, that is where most start and why they are not successful attempting to scalp trade. Scalpers need lots of volatility. Scalpers want the directional bias of the market to be changing constantly. Trend followers steer away from volatility. Trend followers need the directional bias of the market they are trading to be consistent. Trend followers cannot trade in range-bound conditions. Trend followers typically have more losing trades than winning trades. They need the winner to then overcome the losers. Scalpers love range-bound conditions and can trade in either condition, trend or range. Scalpers have more winning trades than losing trades, and that keeps the trader in a positive trader frame of mind, which is important because trading ultimately is 90% psychological. The Forex is the perfect market for scalp trading. The Forex is the most volatile market on the planet, which means more trading opportunities for the scalper. The Forex is range-bound 80% of the time and trending 20% of the time. That's why a trend follower will have a losing trade, a losing trade, a losing trade, and then when price starts to run in that 20%, hopefully the winner will once again outpace the losers. To use a trend following technique, trading the Forex, you have to use extremely large stops. Because of the consistent range-bound activity that occurs, we have to overcome those ranges, and it's very common to have to trade with stops that are 200 pips or greater. Because of the large stops, which also equates to greater risk, trend following requires trading accounts in excess of $25,000 in order to be aligned with sound equity management principles. The larger the risk, so too the larger the profit, but also the more capital required to trade. If a currency pair moves on average 75 to 100 pips a day, how easy would it be to find one 15-pip move, which would equal a net 10-pip profit on average? Average transaction cost is anywhere from 1 to 5 pips, so taking the high side, looking for a net 10-pip move, it'd be pretty easy to find one small 15-pip move. How would you like to make $500 in under 30 minutes instead of 6 to 8 hours? Scalpers do that. They hold on to trades for shorter periods of time, which is less stress and anxiety. They work off of tighter stops, which is less risk, and they grow their profit simply by adding more lots. Trend followers have to hold on to trades for hours, days, and in some cases weeks. The reality is there's also a higher probability that you'll be able to find a net 10-pip move daily rather than a 100-pip move, which means less stress and anxiety once again. Technology now makes scalping possible. Interestingly enough, we're now at a point where telephone access via a landline for the individual is now at a decline. Cell phone technology has overtaken old telephone technology. People are finding that they don't need to have a telephone with a landline at home as well as a cell phone. The cell phone is sufficient. Trend following is a dated style of trading. Scalping is on the leading edge of technology. You could trade 5 lots on one net 10-pip trade, and that would equal $500, and typically the trades are in under 60 minutes. Instead of hours or days in a trade, there is simply no need to trend follow in the Forex market. You can make the same money in less time. So you ask, then why are not more people doing it? It's simply mindset. Scalping is the cell phone as trend following is to the land-based phone. The cell phone has to slowly overtake the land-based phone. The next generation, there will be more people scalping than trend following, I'm sure. To learn more about scalp trading, the Forex, attend one of our free online trading seminars. You can register directly on our website at theforextradinginstitute.com. Once again, I'm Steve Rising. Thanks for your time, and I look forward to seeing you in one of our next online seminars.